Well, here we are in Phoenix, Arizona. It's the first part of February 2023. All kinds of things are happening. We have changes going on everywhere. We've got political turmoil. We've got historical interest rate turmoil. We have kind of an antagonistic Fed. And yet here we are in Phoenix, Arizona with a growth phenomena that is just going crazy. So what do we do? Let's go through what we see and what we have going here in Phoenix. We'll share this with you. If you're from out of state or over the country, you probably just don't realize what's going on here in Phoenix, Arizona. Well, let me go to my very first slide. Let's just talk about that and see what we've got. So we have an unstoppable trend. We have got demographics and we have a lot of economics that are so terribly favorable for the greater metro Phoenix area and Arizona. We're right next door to California. We're not too far from Silicon Valley. We have tremendous climate and we have opportunities. We have a very, very friendly and business favorable administration here. Arizona just lowered its income tax from 4.5 to 2.6. So rates have come down. This is because we have lots and lots of surpluses. Very good government. So what we see here in Phoenix, Arizona is a generational opportunity in Metro Phoenix. We, of course, are in the wealth building business, and our fervent desire is for you to get rich. We want you to create wealth, and not only just wealth, but generational wealth. And we see that as a strong possibility to do that. So here's what's going on. Now, if you've seen some other videos, you might have seen these before. Wall Street Journal just did a documentary on our Arizona 303, which is kind of the new truck loop on the west side of Phoenix. It's only 17 miles, and it is literally booming. There are cranes and construction all along the way. Right at the moment, we have over 40 warehouses under construction, and they're all 500,000 square feet to the more favorable 1 million square feet. We've got Wolf, we've got Amazon, we've got Dick's Sporting Good, we've got UPS, we've got Ball, we've got Red Bull, and it is just exploding because it's so much cheaper to do business here in Phoenix, Arizona. You offload the goods out of California, you bring them over here, and you can warehouse here. You can service Texas, you can service New Mexico, Utah, Nevada, Arizona, and of course you can truck it back to California. And it's so much cheaper than Long Beach. So not only that, but of course, when you have workers here, workers get a very affordable lifestyle. You can buy a house here, very, very affordable housing here in Arizona. At the moment, you can buy a brand new home, 15, 16, 1,700 square feet, full tile roof, granite countertops, all appliances, stainless steel, front and backyard landscaping, in a good school district, good transportation, great climate, and it's about $370,000. You can't get that anywhere near California. This is a brand new home. So this is available. We have them all over here, but particularly along this area, this is just a great place. We have some existing homes that you can move right into. They're a little closer in, so maybe they're more desirable for you, but housing very, very affordable. Great schools, low crime, great climate. So what's there not to like? Look what else is going on. Let's go to this one. You all know what this is. This is the Taiwan Semiconductor manufacturing chip plant. Arizona, of course, was chosen. And we have 8 plants under construction. Now, President Biden was out here about 3-4 weeks ago, and he made a startling announcement that the Taiwan Semiconductor is going to quadruple their position here. So they're going to go from a $12 billion facility to over a $50 billion facility. They're going to have 32 chip plants. This is going to be one of the greatest chip facilities in the world. And of course, we have Intel here in Arizona as well, here in Chandler, Arizona, just down the road from this facility. So this is just going to bring in jobs, and we're not talking about retail jobs or entry-level jobs. These are really incredible jobs, plus all the supporting facilities. There's just tons and tons of companies that support these facilities. Not only that, but these are high-paying, these are intellectual jobs, and they're very long-term. So we're talking about generational opportunities for people, and this is what we're looking at. We find this absolutely outstanding. We're really, really pleased with this. Now, here's what's going on too. Now, BNSF Railroad just was awarded the winning bid. They've added to their 500 acres with another 3,500 acres. And this is going to be an intermodal transportation facility. They're bringing in rail. And again, we're going to be able to ship from California, from Long Beach, bring it right here and distribute all across the Southwest. This is just going to bring in jobs and jobs and jobs. And again, it's $1 billion facility. This is going to be state of the art. This is going to be an incredible, incredible facility. Again, well-paying jobs. These are going to be really, really good long-term career opportunities for people. What's there not to like? There's more. Let me go to more so that you can see this. So what we have going on here is just literally astounding. Now, couple that, we've just completed another freeway that completes the loop around the south section of the city, opening up tons and tons, acres and acres of investable land. And of course, that's going to be housing and more factories and more facilities, more commercial. And on top of that, Arizona is becoming a new Silicon Valley, because we're just as smart here as we are in California. Startups can come here for a tenth of what it costs them in California. And of course, everyone's remote anyway. So again, if you're working at a startup, you can buy a very affordable housing in a great neighborhood, great climate. And this is very, very good for Arizona. Long-term, we're talking about probably a decades-long trend, maybe 3 decades. Really, really good. And here's something else that's not stopping, is Californians are leaving California in droves. Thousands and thousands and thousands of people are leaving California. And of course, these are entrepreneurs. These are people with money. These are people with dreams. These are people who want to do something with their life. They're the ones that contribute to the tax base, and they're coming here to Arizona by the thousands. I think California lost 300,000 or 400,000 residents, and they were said to have lost like $10 billion in tax revenue. Well, here in Arizona, right here in Phoenix, just here in Phoenix, we got additional $2 billion from people who used to live in California. So thank you, California. We're going to make very good use of that, because it's almost impossible to do business in California. So they're just pouring out. And people are saying, why do I have to put up with all that? You don't. Come here to Arizona. Just come here. The weather is great. You can buy a house for a third of what it's going to cost you in California. The climate's phenomenal. Play golf every day of the year if you like to. Here you play tennis all the time. Pickleball is a big one. And it's dynamic. You get here, you can just feel the excitement in the air. It's just absolutely outstanding. We think this is going to be a decades-long trend. And this is a great place for you to invest your money. So let me go to my next slide. Let's continue talking about that. So we are, of course, in the investment business. We take care of people's money. We want to make sure we get a return on it. We want to get cash flow on it. So we think there's a generational opportunity here in Metro Phoenix. We think that if you came here and you brought your workers here, that all they would need is a little credit, some income, and a little down payment. And they can do very well here. You know, we have very affordable housing. We have very good financing. Taxes are incredibly low. So what a great place. However, we want to get from here to there. We think that we have some problems coming along in the meantime. So now we're looking at decades-long trends, and we have a small window of problems coming. So nothing lasts forever. Everything cycles. And of course, we're coming to the end of a cycle. We have a antagonistic Fed, so we don't want to fight that Fed. So let's just go and see what we're talking about, what we see in the economy today. So as I've said before, we've been talking about this for 8 or 9 months. We saw that once the yield curve inverted and we started seeing what's going on, and the Federal Reserve said that they were on a path to raise interest rates, we thought, well, we have a recession coming. I think it's getting very, very close. I'm anticipating it within the next, probably next quarter, where it's going to be very, very evident for it. It's going to come. I think it's going to be a pretty nasty recession. I think we all need to prepare for that. And of course, preparing for it is watch your spending, build reserves, get your credit cards and your debt paid down, and get your cash. Get your cash together. Make sure that your income is secure. We want to make sure your job's secure. But we're pretty sure a recession is coming, and it will be a pretty bad, nasty recession coming. So one of the reasons, I'll hear some of the statistics that we've seen, is that we've had this terrible, terrible job discrepancy between the establishment survey, which is the Bureau of Labor Statistics. They use a model and are constantly adjusting the model. And the household survey, now the household survey literally just picks up the phone, calls people in the household. Are you working? How many in the household are working? What are you making? Is it a full-time? Is it a part-time? And we've seen a huge change. Now, there's been an enormous discrepancy between the household survey, where they're calling people, and the establishment people, which is using a model. So as of June, we had about 1.5 million job discrepancy, and Bureau of Labor Statistics has been saying that it is more jobs than what the household survey. It's gotten to the point in November, it's 2.7 million job discrepancy. So look what's going on here. We just got this from Bloomberg, literally just got this from Bloomberg. And here is their quote. The establishment survey, the government's updated seasonal factors may have impacted the headline payroll figure. On an unadjusted basis, payroll actually fell by 2.5 million jobs. Did you get that? 2.5 million jobs. So if we've got 2.5 million less jobs than what we thought we did, we're in trouble. There's been a lot of things saying, oh, well, the employment is holding out. Well, employment is a lagging indicator. They're the last. No one, it's so hard to get a good employee. No one wants to let them go. And of course, these are people. You want to make sure that it's the last thing that you do. And laying off of people is the last thing you do. But you cannot pick up any kind of media without realizing all the jobs that are going away. Amazon, 10,000, Facebook, 10,000. We're losing high-tech jobs. Again, very good jobs are going away. It's in the news everywhere you go. So finally, we're starting to realize the fact that, hey, we don't have the jobs that we thought we did. So let me go to my next slide, and let's just talk about that. Now, one of the reasons that we've done so well since the 2020 and 2021 were just off the charts busy was an historical amount of liquidity was added. Let me see if you can see this. This, of course, goes all the way up here. I hope it goes past my little viewer here. And you can see this. And this is a historical pop. Now, what do you call this? You can see this has gone for like years and years and years and years. And all of a sudden we get here. There's a lot of money put into this. I call this a bubble. You can't hardly look at this and not realize that this was a bubble. It was a very short-lived bubble, but look what's happening here. That they put a lot of money out, and now it's being drained. And so there's no more liquidity going in. So you absolutely positively see a bubble. Now that was called the everything bubble, and it's as evident as you can possibly see. It is certainly there. Now, here we go, start taking a look at another chart. This I got from Zero Hedge last month. And you can certainly see that the M2 money supply is crashing. It went up. Remember, we put out trillions of dollars went into a lot of people's savings accounts. They were flush with cash. Buildings had, property owners had cash. We had all kinds of cash was into the economy. And of course, when there's liquidity, when everybody's got money, they're out partying, they're spending, buying new cars, new trucks, they're buying new furniture, new clothes, new houses, and of course they're spending that money. Now look what's happening. This is an absolute statistic. We can see a year-over-year change is that the M2 is coming down. And I'm going to tell you, it's one of our leading indicators. When this comes down, the economy is right behind it, but it's about a 16-month lag. So just keep that in mind. It's a 16-month lag, 1 year and 4 months lag. And look at this. Here again, this is coming out of the Federal Reserve Electronic Data System. So March to July of 2020, March to July, just March to July, $5 trillion was released into the economy. $5 trillion. Another $5 trillion was released here in this area. So we've had a total of $10 trillion in liquidity, and it's been coming up. And so what do you think happens when you put $10 trillion of liquidity into the marketplace? Do you think you're going to get inflation? Do you think things are going to go up in price? Do you think there'll be lots of jobs, lots of activity? Of course, there's money everywhere. And now not so much. And right here, March 2022 is when we peaked in the liquidity. And now liquidity is being spent, it's being used, and there's no more going in. So we're back down. So liquidity is being drained. And look at this. Here we are looking at it just a little closer. This again this is coming out of Federal Reserve electronic data. And we're losing $90 billion a month of liquidity being drained out of the system. That's why when we go back to here, you can see it, $90 billion is coming out of the system. All this is being drained and it's coming out. Now, it went places, so it's gone, but it's being drained. And at $90 billion, when you have liquidity that's being drained, that means there's activity is going to slow right along with your liquidity. So when liquidity starts getting scarce, business really, really slows down. And the Federal Reserve, that's called quantitative tightening, and they're taking $1 trillion out of the economy. And it's a historical liquidity drain. Look again, look at the pop, and now it's actually below zero. There's no liquidity. They're draining this. This is historical. We've never had such a lack of liquidity ever. Ever is a very, very long time, and it's being drained. So what does that do? Well, I'll tell you what, inflation follows liquidity. Remember that 16-month lag? Well, lots of things lag with that, and so it's kind of like a magic number. It takes about 16 months, just like it takes 9 to 15 months for the Federal Reserve's increase in the interest rates. There is a lag. It takes 9 to 16 months to start to feel the effects of the increases, and we're just now starting to feel them. So we have 16 months. So consumer price inflation also follows. Now that we've turned over. We got up to 8.9% on a CPI. I know there's lots of different categories for the CPI, so it gets to be confusing. I think we got up around 8 or 9%. Food was much more than that, but so you can see that we've turned a corner. Now, when you pull liquidity out of it, we're going to have deflation. This is going to start things coming through and coming down because there's liquidity is being drained, it's going away. So that's deflation. So we have a deflationary environment. Also, this is not the video for it, but let me just tell you, at this juncture, we have $3 trillion in corporate bonds that are triple B. Triple B is one notch above junk. $1 trillion of those triple Bs are coming up for renewal this year, 1 trillion next year, and 1 trillion the year after. And those bonds are going to go from a low interest rate, some of those written at 2 and 3%, and they're going to go to 8 or 9%. So these companies that really they're not good credit risks, their debt service is going to go through the roof. They're going to get double, in some places, triple the debt service that they were experienced before, going into a slowing economy. And of course, these are bonds, and if they default on them, that's deflationary. So I'm telling you that couple all this together, I think we have a pretty amazing time coming. So we just need to be prepared. So if you look at this, I think we're going to see business activity just follow that down the path. So let's go into my business. So this is where we are really the best. Again, this is coming out of Federal Reserve Electronic Data System. You can clearly see the bubble in the 2005 through 2007. This is the big bubble, and of course 2008 you got the waterfall effect, and it came down. And here we are in 2010. It's starting to bottom out, but the big fall was really 2008, 2009. It had a pretty substantial recession as well, and then it took a little while. Typically, it takes about 4 years. Then we start the journey back up, and again, here we go again, right into the explosive phase, which is what we're finishing now. Now, again, this is this side of the bubble. You can't see the other side because we haven't completed it yet. But I sure think we are here coming up. We've come up around the top, and then we're going to complete that bubble. And this is that section that we just haven't completed yet, but we can extrapolate it out. So I think housing is probably fully valued at this juncture. We just need to be very aware of what we're doing. Now, I'm going to tell you that Charles Hugh Smith, who's on Zero Hedge, Zero Hedge has given me permission to use their charts and indexes. Charles Hugh Smith has done an absolutely outstanding job of using bubble symmetry, and of course extrapolating this to the housing bubble symmetry. But you can see here's bubble one, which is what we were talking about, 2005 through 7, and then the 8 waterfall. You can see it pretty here. Then of course you've got about a 4-year tracking, and then it starts coming back up again. And here you are. This is that section we were talking about. This is the explosive phase that is in all of my videos, by the way. We've been talking about going into the explosive phase. And Charles Hugh Smith has put in the expected fall, and he's quantified it. So now he thinks we could go 30%. Now, I've often said I think we're going to go 35%. Well, probably, my estimation, I think we're going back to prices 2020. Maybe to 2019, I think we'll bottom it. Of course, if it becomes a pendulum's never going to stop where it's supposed to. It'll go further beyond, and that's what Charles Hugh Smith is saying, that we could get a 60% retracement all the way back to the great financial crisis. That would be some kind of retracement. I personally am not on that train yet as to thinking that's what's going to happen, but he's done some remarkable work. I really respect his work. And so there's a possibility. I think we've got 30-35%. I think that will happen. Some metropolitan areas less than others. I think here in Greater Phoenix, we're probably going to be less impacted than lots of other areas. And that's principally because we are a in-migration state, not an out-migration state. There's you talk about Wisconsin and Illinois, New York, New Jersey, Washington, state of Washington, Oregon. These people there's a lot of people leaving out. Same with California, a lot of people leaving, and we're getting them. So that really I think that's going to be a cushion for our market, but I don't think we're going to be immune. I think we're going to see prices come down. We've already seen about a 9 to 15%. So let me just go to my next slide here. So here's mine. I've shown this many times. This is a stylized version, but I think we're here. I think we're coming to the very peak. I think we're going to come to the end of it. I have been asked many times. I think that this peak here is probably second quarter of this year. So not long ago from here, I think it's coming, and then I think we have some kind of a retracement that goes back, and we retrace some of the prices, just the prices, and then we'll start the cycle all over again. So here, if you put these two side by side, you can see that they're very similar. I mean, his chart, my chart, gosh, I was amazed when I first saw it. I thought he did absolutely outstanding work. Some hat tip to Charles Hugh Smith. I thought that was great. So let me just get to my next slide here, and let's talk about this. So what does that mean to you? Well, for the last year and a half, we've been on kind of a moratorium on fresh capital. So, and that's just new capital being put into the marketplace. Now that doesn't mean if you sold something, you're buying something else. That is old capital. That's seasoned capital. That's money that's already in the marketplace. It's already been at risk. It's risk capital. And of course, if you sold in California and it went up, $500,000 in California, and you came here and you paid over what you paid, what you could buy it now for, well, they kind of worked each other off. You bought with inflated dollars, and you paid with inflated dollars, and you bought inflated dollars. So those guys kind of work themselves off because the market worked on both sides of it. Problem we have if we have things coming down is that we're just a little cautious on putting fresh capital into the marketplace. So if you have a 1031 exchange, I think that's fine. You have risk capital already in the market going to risk capital. They kind of wash each other out. If you sold a house in Texas and you're moving to Arizona, I think that's fine. The people we're just a little concerned about is putting limited amounts down. So that would be first-time home buyers are always at risk. If a market, you put 5% down, the market moves against you 10, well, you're underwater. So that's not a good thing. And of course, if we're building for a portfolio, we just want to make sure that we're building and it's a long-term portfolio. So I do see a problem here for the next 2 or 3 or 4 years. As we get closer going out 3 or 4 years, I think it becomes less and less of a problem. But in the meantime, I think we have an adverse Fed. I think it's an aggressive Fed. So we don't want to fight that, and we just want to sit back and watch. Now, but that being said, if you're in some areas that you want to get out of, we've talked about them already: Wisconsin, Minnesota, Illinois, New York, New Jersey, parts of Washington State or Oregon, and certainly California. You can go ahead and move that here. And I think if you just use seasoned capital, I think you're going to be fine. And the opportunity here is incredible, just incredible. So let me just go to my next slide here, and we'll talk about this. Is that I am with West USA. They do our back office. They're a $5 billion firm, a big firm. Maybe you're comfortable with it. If you need to reach me, we're more than happy to talk with you, even if we're looking at something that might be 5 or 6 or 7 months down the line before we want to make any kind of moves. But you can reach me at the corporate office, and you can always reach me and do some of my videos, where my email is, and be more than happy to work with you on this. So let me just recap a little bit. I think we have incredible opportunities here in Phoenix, Arizona. They are decades long, 30 years probably, maybe 40. We have a really, really good demographic trends. We have great growth vectors here in town. Great place for you to put money. I think we have long-term money, and of course 5-10 years goes by pretty fast. I think you're going to do really well. We have properties that cash flow really well. Currently we're looking at 4.5 to a 5 cap, and that's after everybody gets paid, of course. So I think it's just a wonderful place. You're welcome to reach us. We're more than happy to discuss what's going on here. I think we do need to be cautious with putting our money in. If you're a first-time home buyer, I think you are going to have some terrific opportunities. We've already seen prices drop, and I think you're going to drop a little more. So had you bought something last year and been the winning bid, beating out all the investors, being optimistic, I think you're so much better off not getting that winning bid, because I think prices have come down $50,000 to $60,000 to $70,000. Yes, interest rates have come up, but prices have come down. So I think you're so much better off with a lower price than a higher interest rate. So I think it's just been great, and I think you're going to have opportunities to buy some really, really good properties. So there's a balancing act here. I think we have great opportunity, and we have to be a little bit concerned with the volatility that we're going to see in a short run. So I'd like to leave it with this. I think that we have a terrific opportunities coming. We just need to be cautious. There's nothing to be afraid of. We've got probably another 5 or 6 very good months coming in front of us. I think interest rates will trend down just a little bit. And then it's going to be a kind of a period where we have a moratorium, but then you're going to have an opportunity of a lifetime. You're going to have prices that are going to be at rock bottom, and I think you should explore buying as much as you possibly can. We're here to help you in any way we can. Thank you so very much. And oh, by the way, I could really use some help with the video. If you like our videos, give me a thumbs up. And we're trying to get our subscribers up over 1,000. If you like our videos, please subscribe. My best to you. Bye-bye now.